All right. Welcome. Great to have you here. We are officially about 4 minutes away from the start, but I like to hop in a few minutes early. If you've been on webinars with us here at VectorVest, and me in particular, you know that we like to make sure all the technology is working and, of course, to welcome you to the session. So if you can hear me, find your chat box. All right. Welcome. And just type in a big yes in the chat box for me. And by the way, you can find your chat box if you're using GoToWebinar's software. It'll look something like this. Let me get my laser pointer here. Now, some of you might not be using GoToWebinars, or you might be using GoToWebinar's app or on a tablet, and it might look a little different. But you will see either a box that looks like this, or if it minimizes, it'll look something like this. Just click on the orange button, and then you could find your little chat box over there. So I see some people are already typing in. I see Rosie, Adam, Mike. Hello to all of you. And in my GoToWebinar panel, I see Donald, I see Tony, Gary, Jim, Bart, Michael. Welcome to all of you as well. We're about 3 minutes away before we officially start. Welcome, Cedric. Great to see you. All right. So in the chat box, we're going to be using this chat box quite a bit today because it's a very interactive session. I got questions. As we look at some of the examples, I'll be asking you for some, not just your feedback, but I'm going to try and ask you to apply the things that you've learned in today's session. So let's get used to that chat box a little bit more. So if you can find it again in the chat box, let me know. How about this? The time that it is by you, maybe even your location. The time will let me know kind of the time zone we're dealing with. Here it is in Eastern North Carolina. I feel a sneeze. Hold on. I am hoping I muted my microphone in time because that was a fairly loud sneeze. All right, so looking at my chat box, I see 1:30, White Rock, 4:28. That's the time it is here in Eastern North Carolina, 4:28. I see 1:28 in Arizona, 4:30 for Ed, 3:30 for Jim in Minnesota. I see a bunch of 4:30s coming in. I see Rosie is in Washington, D.C. East Coast for Adam. 1:30 in Seattle for Mark. All right, perfect. All right, so I don't see any nobody, at least nobody's typed in who's overseas yet. I did a webinar yesterday, and we had people from all over the world in that session. So far I haven't seen any of those. So I see DJ from Houston. All right, so I'm glad you're finding that chat box because, like I said, we're going to be using quite a bit in today's session. While we have about 60 seconds before the official start of the session, I want to tell you how to get the most out of it because this is a very educational, very informative webinar as we go through this whole thing. Hopefully you'll see that. And now some of you are watching on the YouTube because just in case there's some sound problems in GoToWebinar, we like to have it on YouTube as well. Make sure you comment in the chat box with us as we go. Comment in the chat box, hit that little thumbs up if you're finding it informational. Before we start, we got about 30 seconds. Here's how to get the most out of it. Number one, make sure you have something to take notes. Pen, paper, and a drink. Number two, get rid of distractions. All right, so if you have a cell phone, just turn it off. If you have a door, close it, that type of thing, because you really want to focus. Because we got a lot to go over. So really focus in today's session so that you can get ready to learn. All right, so those are the 3 gets in today's session so you can get the most out of it. Here we are. Let me get my laser pointer back out. I see on my clock it's 4:30 Eastern time, so it is time for us to get going. So just give me a second. Let me start things up on my end. There we go. Let's officially start today's webinar. Welcome to the session. It is titled How to Generate Income Using Credit Spreads. It's a complete guide to what these credit spreads are. As I hopefully mentioned when we were doing our Getting to Know You activity there at the beginning, my name is Brian D'Amico. I am one of the investing coaches here at VectorVest. I'll mention that again a little bit later on to tell you a little bit about what VectorVest is. I'm really excited about this. This is a very educational, very fun, interactive webinar. It's teaching you about one of my favorite trades called credit spreads. And I'm glad we're able to be here together to go over this. For this next, we got about an hour together. I'm going to give you everything I possibly can. I tried to squeeze as much as I could in this hour while still making it so that you could understand it and follow it as we went. All the things that we're going to be covering today are based on real results. This is a trade that we do every single week with our coaching clients. So we want to teach you about it today. They're getting tremendous results. We get tremendous results with this trade. So I think it's going to be very beneficial for you to take some great notes and start to implement this type of trade in your own investing. At the end of today's session, since there's only so much we can cover in an hour, if you do want to get more help from us or even get results faster, I'll tell you about basically the next course of action if you did want to do that. But I guarantee you, I'm going to pack as much educational content into this hour as I possibly can. All right, so if you are ready to go, in the chat box, give me one more big yes that you are ready to go, and that'll tell me to move on from the webinar. Keith, you're the first one in. Mark, Edwin, I see yeses down the line. Awesome. I like to start off with a poll, and I'm going to put it up on the screen because I want to get to know the audience here. So if you're using GoToWebinar, you're going to see this appear on your screen. If you happen to be watching on something like YouTube, you won't see it. You'll just have to type it into the chat box. Select one of those choices there. So how would you rate your overall experience level with options? I want to get a feel for who's with me today. Do you have no experience? Like you haven't done anything with them? Maybe you've kind of just heard about them, but you haven't actually done any real trading with them. Maybe you're a beginner. You kind of know the basics of calls and puts, or maybe even bought a call or bought a put. Intermediate, I'd say that would be people who have done covered calls or spreads. And advanced, you would know if you're advanced. If you consider yourself advanced, you're going to select that one. I'll give you 5 seconds. Let me know by selecting one of those. And let me close this. And I'm going to show you the results. Now, again, if you're on GoToWebinar with me, you're going to actually see these results showing up on your screen. All right, so I see, wow, all right, so we got 43% saying beginner, 25% or a quarter of the room says no experience, 28% intermediate, and only 4% advanced. I've done this webinar where we had like 15% in the advanced category. So, hey, if you're advanced, hopefully this is going to be a great refresher for you on some of these techniques. If you are intermediate, which means you've probably dabbled in either covered calls or spreads, you should have an idea of what calls and puts are, but hopefully I really feel this is going to teach you another trade that you could be doing. Or if you've been doing spreads, this is going to teach you maybe to you in a new way and kind of give you some aha moments. And if you are in the beginner or the no experience category, I want you to do this for me. I want you to write down something on your piece of paper. And hopefully you do have a piece of paper to take some notes. I want you to write down 4 words. I can do this. And if you're an experienced or an advanced person, please in the chat box, let those people know who are inexperienced that this is a trade that they definitely can do. I can do this. So I want you to write that down. Because not only is this a trade you can do, it's a trade that you should do. Now, why is it so important? Because we all have recurring bills, things like a mortgage, things like a cell phone, car payments. And no matter where you are in life, you have recurring bills of some sort. All right, unless you are don't have a cell phone or something. Don't pay Netflix, All right, but as you get towards retirement, or even if you are retired, we talk to a lot of people who fear that they might not have enough income because their job is over, right? They don't, and their Social Security or their pension might not be enough to cover the bills. In fact, you've probably heard the stories where more and more Americans and people across the world are at retirement age and they still have to work. So we don't want that for you. We want you to be able to have a way to have that steady income so that you can retire and live the lifestyle that you want. So today we're going to be talking about options, and specifically a multi-leg option trade called a spread. So a lot of people, when they're getting into option trading, they feel, oh, well, options are risky. They're complicated. They're, something that only professionals should be doing. But, the answer is no. They're not risky. They're not complicated. And yes, you could do them, right? Not only professionals, but you, right? Because in today's webinar, you're going to see that these trades involve actually less risk than just buying the stock outright. Just buying shares of the stock, which a lot of people do if they're bullish. You're going to see that you could do this trade, this spread that we're going to talk about today, and it's a lot less riskier, right? There's less risk than just buying the stock. Less margin is required, right? So if there's less risk, it means there's going to be less margin requirement, and you're going to see that math today. And if you have a small account or a large account, you could do this trade. Right? I'm not going to ask you to type in the chat box how much money you have in your trading account, but you could do these trades even if you have like $3,000. You might only be able to do like one spread or so, but you can get started. You can do $5,000. You could do it up to several $100,000 in your account, right? So you can ramp it up. And the benefit of the trade today is, now I put on the lower end 70%. Our base trade, actually, we started off with a 60% probability, but based on some of the ways that we set it up with the market in our favor, it puts it up to about 70% to all the way up to 90% winning trade percentage. All right, so probability is on our side. We're going to look today how the trades can be done in up markets. That's the first trade we're going to look at. The second trade we're going to look at is a trade that you could do in down markets. When the market either stalls or starts to go down. And I mentioned when the market stalls, if the market starts to go sideways, which we've experienced, right, over the last, month and a half, the market's just been up and down. It's just kind of channeling, right? These trades are perfect for that. All right, so up, down, sideways, you could do this trade. Always remember, you can do this. All right, you can do this. So here are the objectives of today's session. All right, number one, what I'm going to do is I'm going to help you understand the trade. And what I like to do is I like to draw it out first. So that way you can understand it conceptually. So I'll draw it out first. And then after you understand the concept of the trade and kind of what's going on, then it would make more sense to walk through an exact example. That's when we'll pull up a chart of a stock and you'll actually start to put some more numbers to it. But, I like to call it adding layers to your knowledge sandwich, which means you're going to add one layer, which is just kind of the concept of the trade. Then we're going to look at an exact example where you can start to say, oh, okay, now I understand some of the numbers behind what's going on. Then once you do that, then I'm going to have you apply what you learned, right? We're going to look at case studies, and I'm not just going to show you the case study and explain it all to you. That's where I'm going to get you involved. So be ready to participate more in that case study section, because I want you to actually walk away from today's webinar feeling pretty confident that you know how to set up these trades for yourself. All right. And then at the end, we'll wrap it up and I'll give you that checklist and some action items of things to do. All right. So again, my name is Brian D'Amico. That's a face to put to the name. I'm an investing coach here at VectorVest. And in fact, VectorVest has been around for over 30 years. You can see just part of our team there. That's our education team. We've also got a tremendous support team available there to answer the phone. But it's not just me. We're not just a fly-by-night company. We've been around for 30 plus years to help you become a better investor. All right, so why don't we jump right into it? Let's get into the difference between a standard trade and an income trade. That's going to lay the foundation for the rest of the session, because we need to start off with a common ground, right? So a standard trade, this is like a typical trade, and it's one where you're only going to make money if you're right on the direction. Okay, these are trades you virtually do all of the time. Basically, like buying shares of a stock. Right? That's a standard trade. Now, an income trade, our definition of an income trade is one where you can make money whether you are right or wrong on direction. And you might think, well, how is that possible? How can I make money if I'm right or wrong? And the key part there is wrong, right? You're probably thinking, well, how can I make money if I'm wrong? Well, here let's take a look at a standard trade versus an income trade. And for this, I'm going to start out by drawing things out like I said I would. And for some, I don't like to use the red color. Let me just change the color here to like how about a purple today? All right. So it all starts with you finding a stock that you like. And if you're going to buy a stock for a standard trade, you're going to start off by hopefully buying a stock that's in an uptrend, right? So let's start here. It doesn't just go straight up, right? So we're going to start off by buying a stock that's in an uptrend. And with that stock, if you were for a standard trade, what do? Well, you buy shares of it, right? And you buy the shares at the current price. So like right here, that's where the stock is right now. And so you buy it. And then what happens? Well, one of three things will happen. Either the stock will go down, right? And you lose money, and that's bad, right? The stock will go sideways. Now, you're not losing money, but I'm also going to say that that's bad because you have your money tied up in that stock, and it's not making money for you. It's just tied up, and you can't do anything else with it. And now the third thing is it can go up. And that's the good part, right? That's the one out of the three scenarios where you make money. And so in the standard trade, you only make money if you are right. Okay? You only make money if it goes in your direction. So now let's look at the income trade. The income trade, believe it or not, still starts off with you finding those good stocks that are in an uptrend. You know, a lot of people think, oh, I need some special skills or special techniques to find my stocks. No, if you're looking for bullish stocks, bullish trades, you're going to select the same types of stocks that if you were to buy them. All right, so a stock that's in an uptrend, but instead of buying it at the current price, what you're going to do is you're going to pick a price where you don't think the stock is going to drop to. And I'm going to add more and more to this as we go on. Right now, I just want you to understand this concept. Remember, we're going to add layers to this as we go. Understand, you're going to pick a price where you don't think it's going to drop to. For example, let's just say here's an area of support, right? You think, oh, well, it's probably not going to drop down to there. So you pick a price, and I'm just going to draw a line here. Just understand at this point that you're going to get paid up front for selling that option. Right, so we're gonna sell options. Now we're not gonna sell naked options. So those of you who are worried that we're gonna do naked options, nope, we're not doing naked options. We're not having unlimited risk. I'm gonna add more to this in a bit, but just understand you're selling an option here, and as long as the stock stays above that price, whoops, it helps if I actually can draw straight lines, right? There we go. As long as the stock stays above that price that you selected, you make money. All right, so what does that mean? Well, the stock could go up, you make money, right? Because it stayed above the line. Stock could go sideways, you can make money. Now, it might take a little bit longer if it goes sideways, but you could still make money. Now, the stock could come down, and you could still make money as long as it stays above that line. Now, of course, if it goes below this line, I'm going to put an X there. That's where you lose money. All right. So this trade, there are going to be times where you lose money. But the key is you have basically let's call it 2.5. All right. But basically at least 2 out of 3 scenarios where you're making money. And we can even say 2.5. Okay. So that's an income trade. So you can make money whether you are right or wrong on direction, and you could still make money. All right. Now, the same could happen in a down market. So let's erase all of this. You're just going to find bad stocks in a downtrend, and you just have to pick a price where you don't think it's going to rise back up to. Let's say like up here. All right. So if it goes down, you make money. If it goes sideways, you just make money. It could even go back up a little bit, and you can make money. But once it hits that line, we're going to close the trade, and that would be a losing trade. All right, so far so good. All right, so the key is you're going to get paid up front on this trade, and as long as the market doesn't go against you and hit that line, you're going to make money. All right, so now let's add a second layer. This is going to be layer 2 of your knowledge sandwich. Let's now talk specifically about the income trade that we're here to talk about, which is a credit spread. Now, there's two types of them. There's two types of credit spreads. One is a bull put credit spread. One is a bear call credit spread. And I don't want you to get freaked out by those names, especially if you're in the 25% who have no experience. I'm going to break it down for you. Bull put credit spread. All right, there's 4 words there. Let's talk about each one. Bull, put, credit, and spread. That'll help you understand what's going on with this trade. By the way, this is also called a vertical spread. Okay, vertical spread, credit spread. Your broker might call them one or the other. All right, so bull. When you hear bull in the stock market, what does that make you think of? Does that make you think of that you think the market's going to go up or down? Well, if you're hearing the word bull, you're thinking, all right, well, the market is going up, right? Or at least I think the market is going up. Like we're in a bull market. So if you think bull, that lets you know that this is a bullish trade. So a bull put credit spread is a bullish trade, and you should only place this trade when both the market and the stock are in an uptrend. The second part, put. That means this trade only uses puts. So you're going to be selling a put and buying a put at the exact same time. That's the spread. You know, we're not naked. We're going to sell and buy a put, but only puts. Credit means you're going to get paid up front, and spread, that's the difference between the strike prices of the put you sold and the one that you buy. That is how we're going to control risk. Okay, and we'll talk about that in just a second. So let's go back to our example. This is where we're going to add a little bit more to your knowledge. So you remember that stock we had before, the stock that was in that uptrend, right? So you have that good stock that's going up. And remember, you're going to pick a price where you don't think it's going to drop to. And I gave an example before of an area of support. Your broker will give you things like probability. We do use probability as well. And so we're going to say, all right, well, based on those things, I don't think it's going to drop down to here, so I'm going to draw that line again right here. Okay? That is the put that you sell. All right, so I'm going to put sell put. That's the one you sell. Now, when you sell something, whether it be a bicycle, a car, a house, a pizza, right? Whenever you sell something, you get paid, right? Someone gives you money. All right. And I'm going to denote that with dollar signs here. There we go. I'm going to put $2 signs, and you'll see why in just a minute. So now I said we're not doing naked puts, right? So what we're going to do, because a lot of you might be thinking, or not a lot of you, some of you might be thinking, all right, when I sell a put, isn't that a naked put? And isn't there a lot of risk in doing that? Well, yeah, if we just sold a naked put, there'd be more risk involved with that, which is why we don't want that. And that's why we're going to buy a put at the exact same time right here. So I'm going to put buy put. Okay. Now, I want you to think of that as your insurance policy. Okay. Now, when you buy something, and again, when you buy insurance, right? When you buy something, it costs something. So when you buy this put, it's going to cost you some money, but I'm going to put that as $1 sign because you're going to use some of the money that you collected up here to pay for this put down here. So if you think about this, these cancel out, leaving you, right, with a net credit. Right? Leaving you with a net credit, which means you're getting paid up front for this trade. And again, if this trade goes up, good. If it goes sideways, good. If it comes down, well, it could still be okay. But if it comes down and it hits that line, that means you're going to exit the trade. That would be the loss. All right? Now, the mechanics of doing this are just as easy as placing a trade to buy a stock. You just go to your broker and you say, oh, that's the one I want to sell. That's the one I want to buy. You click on the two of them. You basically enter the limit order just like you would if you would be buying a stock. You enter the limit order and then you send it. The broker takes care of the stuff in the background. So both of these would be done at the exact same time on one order. All right. So I put this example in here so that way you could understand the transition from buying a stock to doing just selling a put all by itself to doing a spread. So let's break it down. This is a graph of Costco from a while back. I mean, it was a nice looking chart. Remember, that's what we look for. We look for stocks that are in an uptrend, right? So we're looking for a stock that's in an uptrend. And at the time, the market was also in an uptrend. So on that day, Costco is trading at 207.98. If you were to go out there and be a stock buyer, if you were a stock buyer and you bought, let's say, 100 shares of Costco, it's going to cost you $20,798. And the only way that you make money is if Costco goes up, right? And if you're a stock buyer, you have $20,000 of your capital, right, tied up, and it's at risk. All right, so you got $20,000 tied up and at risk. You basically have risk all the way, the stock could go to zero. I hope none of you have let a stock go to zero. That's very rare, right? We're not talking Enron here, right? So we're not going to let a stock go to zero, but technically you have all that risk all the way down to zero. What about if you just sold a put? It's a very popular strategy. People just sell puts on stocks that they want to own. But if you just sold a put, you might say, well, I don't think it's going to drop down to here. And they say, well, if it drops down to there, I'd be willing to buy it. But when they sell the put, they take on a credit, right? They get paid. So in this example, I'm putting some numbers to it. So in this example, I'm going to change my color here. Give me 1 second. Remember earlier I was saying dollar signs? Think of this as $2 signs. All right, 246, that's like $2 signs. So you sell one put, it generates $246 per contract. But you still have over $20,000 of your capital tied up and at risk, because just selling a put, that means the broker is going to require you to have enough margin to buy 100 shares of Costco at $205. So they're saying, hey, you need to have basically $20,000 to be able to do that. Now, I'm sure they have some margin calculations to figure that out, but basically, you're still going to have that much risk. All right. Well, instead of just selling a put by itself, we don't like to have all of this risk. So what you're going to do instead is you're going to make this a low risk trade. All right. To do that, you're going to make this a bull put spread and simply buy a put a little bit below the one that you sold. Typically, it could be like one strike below. Typically, if it's a stock that has $5 increment strikes, we're going to do the next strike down. So 205 down to 200. All right, that's your insurance policy. And just like any insurance policy, it's going to cost some money. In this example, it costs $121. So if you thought, this was $2 signs, this is $1 sign. So, these cancel each other out, leaving you with $1 sign. That's what I have over here. So instead, you're going to sell that bull put spread and generate $125 per contract. And instead of $20,000 of risk, you shrink your risk all the way down to $375. All right? Because, the stock could drop $5, and that's $5 times the 100 shares that you're controlling. 5 times 100 is 500. And you received $125. So 500 minus the $125 you already got means the most you could lose is $375. Right? So instead of $20,000 at risk, it's all the way down to $375. All right. Now, of course, you don't have to do just one contract. You could do more. You can have a bigger account, and you could say, well, I'll do 10 contracts. I'm going to generate $1,200. My max risk is still only $3,700. That's still a lot lower than the $20,000 if I went out and bought 100 shares of the stock. All right. So let's look at the same thing as a case study. All right. So Costco, if you remember, the example I gave you, it started over here. It went over to here. So technically, I mean, you were kind of right on direction, but not really right because the stock went up 1.4%. You know, the stock went up, it came down, it went up. If you were a stock owner, that'd be kind of frustrating. You know, 2 some odd weeks go by and you're basically only up 1.5%. Well, what if you did the bull put spread? If you did the bull put spread, you would have earned 16% on the money that you had at risk. Right? So if you bought the stock, you would have only been up 1.5% on the money you had at risk. With the bull put spread, whatever money you put at risk, you'd be up 16%. So here, you know, let me get my laser pointer back out here. We have a coaching group, which I mentioned at the very beginning. We have clients who follow along with the trades that we teach them to do. And Frank did this trade on Costco, so did we. And he said he closed his bull put spread on Costco for a net $955. All right, so, let me go back. 955, you're like, well, how do you get 955? Well, on the trade that I was showing you just a moment ago, if you did 10 contracts, you generate 1,250. We're never going to look for the full 1,250. All right, so we're targeting half of that. So what Frank probably did is he might have done 15 contracts, and he just made $955 in 2.5 weeks. All right, so in the chat box, you know, if you had something like that where your risk is lower, you're making more on the money that you've got at risk, and you're making more even if the stock doesn't go in your direction. My question is, if you could make money like Frank did with Costco, where you're even wrong on the direction of the stock, like with Costco, it didn't really go in Frank's favor. It only went up 1% or so. How would you feel if you could make if you had a way to make money and the stock doesn't even have to go in your favor? Donald typed, he was the first one who typed into my chat box here. He said, I'd feel blessed. Steve just said, he's like, Yahoo! Yeah. Let me grab a quick drink. My throat is a little dry. This is, you know, it is an interactive webinar. You know, so we got a ton of people here. Frederick says, good, if I remember all this. Well, that's the key. You got to learn how to do the trade, right? Cerise says, that works for me. Lewis says, great. Ed says, that sounds good. Yeah, so if you could have trades where you make money and the stock doesn't even have to go in your favor, that's going to help your confidence and your results. All right, so that's for a trade that the one we just looked at was for up markets, but you noticed the market does not have to just go up. It could go sideways, and those trades could still work out. So now let's flip it around. Let's do a bear call credit spread. This trade could be done when the market goes down or just kind of stalls. All right? Ideally, it would be done if the market's going down because that's when you make profits the fastest. So we're going to break it down by word again. I'm going to go a little bit faster. Bear means you're bearish. Okay, so you're going to do it when the market is in a downtrend. Or, well, I'll just say it's best when the market's in a downtrend, and you want to find stocks that are in downtrends as well. Let's just leave it at that. Find bad stocks in a downtrend, and the market's in a downtrend. We're only going to do calls, so we're going to sell one and buy one at the exact same time. And again, we're going to get paid up front, and the spread is just the difference between the two strike prices. So if I were to draw this out again, let me get my pen. And this time I will do red because we've got a stock that's going down. Now you might find, since downtrends are quicker Like, you don't usually have a really extended downturn. You know the old saying, you take the stairs up and the elevator down, right? It's usually saying, it goes up slow and then faster down. So usually when you're going to do you're looking for stocks that are in a downtrend, you're probably not going to find a stock that is in a 1 year downtrend. Right? That'd be a really bad stock. And if you can find those, ideal candidates for this trade, the bear call credit spread. But let me just say this. A lot of times we're going to be finding stocks that might have been in uptrends, but now have just started their downtrend. Okay? Right? They're reacting to what's going on in the market. So the main thing is it's got to be a bad stock that's going down. Like, earnings are falling, it's got negative earnings, things like that. So we're going to pick a price where we don't think the stock is going to go back up to, because you think it's going to keep going down because the market is going down. So the thing you don't think is going to happen is you don't think it's going to go up. So you're going to say, well, just in case it goes up, I don't think it's going to go back up to, let's say, here. All right, so that is the call that you sell. So you're going to sell that call. Now, you're not going to just sell a call by itself, right? Because that would be a naked call, and your broker would probably say, hey, you can't sell naked calls. All right? Because, we're not going to sell naked calls. So you're going to buy a call above it. That's your insurance policy. And just like we talked about before, when you sell something, you get paid. So let's say you get $2 signs for that one. The one you buy for insurance, it only costs a little bit of what you got. Those two cancel out, leaving you with some money left over. Okay, and again, both of those trades are done the exact same time on one order ticket. All right, so if we take a look here, this is an example of what I was just telling you about. You have a stock that was in an uptrend that is now in a downtrend. Lower highs, lower lows. It is in a downtrend. You think it's going to continue to fall. Okay, so now we're just going to try and determine where you don't think Facebook is going to rise to. All right, so if you look at this chart, that I'm going to get some more interaction. If you're looking at this chart, where do you think Facebook won't rise to? I'm going to leave the question just as that. I'm not going to give you any more leading information. Where do you think it's not going to rise to? I'm seeing a variety of answers here. 180, 170, 215, 170, 170, a bunch of 170s, 215, 175, 200, 190. I'm seeing a lot of different answers. All right, well, let me say this. All perfectly reasonable answers. Like anything above 157, which is where the stock is right now. It's at 157. If you're trying to determine where Facebook is not likely to go, all those answers are reasonable. They're all reasonable. Anything above here, you're thinking, well, I think it's going to go down. I don't think it's going to go up. But the key then is to figure out, a good mix of based on probability. So there's some give and take. All right. So let's just say like this strike right here might be, you might get $4 signs worth from that one. This one above it might be 3. This one above it might be 2. This one above it, you'd only get 1. This one, some of you were saying $200 a share. You might not even get $1. You might only get a few cents. So you might say, well, that's not even worth doing. Pardon me. All right, it's not even worth doing. So there's a balancing act. So let's take a look at how we can set one of these up. So we look at probability. It's something your broker would show as well. And we had to use a nice balancing act. And we said, all right, it most likely won't rise above 165. That's where you would sell the call. Now, as I said, you're going to receive money. Remember, I drew out $4 signs worth, 455. But remember, that leaves you to all of this risk up here, and you don't like that. So you got to have insurance. So we buy the next one up. That's your insurance leg. All right, that's the 170. It costs some money, 310. Remember, that's $3 worth, leaving you with a net $1 sign, $170. Okay, next, I did my math. It's on this slide, 100, leaving you 145. Hopefully that didn't confuse you. All right. You just generated $145 per contract. Okay, and that's just the difference between 455, what you received, minus the 310, what it's going to cost for the other thing, 145. All right, so you could do 10 contracts. You could do 2, 3, 4, 5, 10. You could do 20 contracts. If you did 10, you now just generated $1,450, and your max risk is still only $3,500. All right, so what happened with Facebook? Well, it did exactly what you thought it was going to do. Well, maybe not at first. At first, it started to go up, and then it came back down. It just followed that same pattern, right? Lower highs, lower lows. Facebook dropped 7%, but you made 20% with the bear call credit spread. All right, so you're making more bang for your buck. So that was an example of how you could use this type of a trade when the market's going down. Now, this is key because when the market goes down, what do a lot of people do? Well, they get scared, right? They sell their stocks. They go into cash. They wait it out. They lose money. But here's the question I have for you, and share your answer in the chat. If you had an income source, even in down markets, how would that impact you? Wayne, you're the first one in. Wayne says it'd be a positive impact. Wow, you and Donald are sharing the same thoughts. Donald says positive. Ed says nice. Marie says I'd be able to sleep at night. Yeah, think about, the market's going down. Instead of losing money or watching your profits go away, you now say, well, I don't have to worry. Like Marie says, I could sleep at night now, because now I have a way that I could start to generate income even though the market's going against me. Leroy says, I'd be able to go to the beach. All right, so let me see if you can implement some of what you just learned. Are you ready? This will help you feel a little bit more confident in these trades because we're going to look at some case studies. So this is an example of a trade that we did on the SPX. And I know the SPX is not currently trading at 2,800, right? But the important thing is it's just an example. We do a lot of trades on the SPX. In fact, probably like 80% of all of our trades are on the SPX, maybe 70%. But we do a ton of trading on the SPX. In fact, kind of like the base system that we do with the SPX, that's the one that could get as high as 87, 88% winners. Over the past year, it dipped down a little bit. Probably we're hovering in the 80 to 90% winner rate with the SPX system. All right, so let's take a look. I want you to get practice here. With the SPX that you're looking at here, it was trading at 28.67. You are bullish. All right, so you're bullish. I want you to go with that sense. And in the chat box, where do you think it won't go? Like, you haven't even looked at any probability numbers. Just go by gut feel right now. Where do you think it won't drop to? So I'm just, in case you can't see I think you can see the scaling over here on the right. That's 2,800. That's this line here. This one down here is 2,750. So kind of in the middle would be 2,775. Now, if you type into the chat box and you say something like, there it is, Tom, you said 2,400. I'm coming to your house, Tom. All right, with 2,400, you're not gonna get paid enough to take on that trade. So we have to be somewhat close. Somewhat close, yet far enough away. All right, so I'm seeing a lot of good answers in the chat box, though. Let me show you what we did. Remember I said we have a coaching group that takes a lot of the same trades that we do. So Doug here, he said, on Monday I bought my first credit spread. Now he actually meant to say I sold my first credit spread. So it was his first one, so he just kind of flipped the terms a little bit. Now he did 10 contracts. on the S&P, and these were his strikes. Way down here, 27.75 and 27.55. All right, and look at all that room. Right? And that's perfect. Like, right, if you can get it below an area of support, this, the S&P has all of this space to move. All right, so it can go from 28.67 all the way down to 27.75. That's like 90 points, right? That's a big move. I should say a big cushion for you. Well, what happened with this trade? Well, remember, you're bullish. The S&P only rose 1%, right? Over the next few days, the S&P rose 1%. And so we got Doug here who says, well, I closed the trade here on April 5th, and he made $1,012 in those five calendar days. Actually, or five trading days, excuse me. 5 days. Let's just leave it at that. $1,000. All right. So the S&P went up 1%. He just made $1,000 on that trade. That's a nice little paycheck, right? All right. Well, let's do a bearish example. Are you ready? So here's one on Alibaba. This is a nice example of a stock that's going down, right? It's in a downtrend. You're bearish. All right. So the stock in this example was 139 at the time. In the chat box, where do you think it's not going to rise to? Now let me get my laser pointer back out, and then I'll draw again. All right. Where do you think it's not going to rise to? All right. So we got it's at 139. Up here's 145. Here's 150. All right, so I see 145, 170, a bunch of 145s, 160s. All right, well, let's take a look. Let me get my pen back out. Well, Manoj, he did a bear call spread on Alibaba. Did the 150 and the 155. Look at that. Did anybody say? There's a couple people. Michael and Wayne said 150. So did Steven. You guys got it? Look at all that space from 139. That's an $11 wiggle room. So keep in mind, this stock, what does that mean? It can go down, which is what you expect. It could go sideways. This stock can even go against you all the way up to 150 before you'd have to close the trade at a loss. Now, I do want you to keep in mind that, if the stock does go against you, you'd see unrealized losses at first. But if enough time goes by, you could still make money. But once it hits that price, you're out, right? It would be a losing trade. But that's a lot of space, right? So what happened? The stock dropped 3.5%. And Manoj typed into I usually cover up the last name. Sorry about that. There we go. He typed in, I'm out with 50% of my max profits. All right, so if he just made 50% in 2 days, let's kind of do some math on what that could mean. So his credit was $1.05, right? So if he did one contract, it'd be $105, right? One contract is perfect if you're just kind of getting started and you're learning how to do this. All right, so one contract, $105. If he had done 10 contracts, all we have to do is add a 0. All right, that would be his credit. All right, so let's say he did 10 contracts. By the way, we interviewed people they have a lot bigger account. We talked to somebody a few months ago who's doing 30 contracts on the S&P. So you can definitely ramp this up. So Manoj, let's say he did 10 contracts, 50% of that, now that's his profit target. That would mean he would have walked away with $525. That's our profit target, by the way. Some people in the chat were asking, when do you close the trade? That's the profit, is 50% of what you take in. He walked away with $525 in 2 days on the trade. And the stock just went down 3.5%. I think I got one more here. Yes, I got one more. This is an example of a trade. a bullish trade on a stock this time instead of the S&P. So this, whoops, I don't want to give it away. This is the stock at 194. You think the stock is going to go higher? Where do you think it's not going to drop to? In the chat box, let me know. Where do you think it's not going to drop to? 190? That'd be really close, right? If you did 190. 185 is like here. 180, 175, 170. Keith and Yuking, Tom, Jerome. All right, so I'm seeing 180s, 75s, 150. All right. Let's see. Well, this is what we did and what Frank did as well. He did it way down here at 180. Look at all that space. It had not hit. That stock had not gone down to 180 in, what was that, 2 weeks? So that's a lot of wiggle room. All right, so all the way down at 180. Now, if you can't, I know you can't see what Frank posted in our private Facebook group, but I zoomed in on my computer. I zoomed in to see what he wrote because the stock went in our favor, and that's usually going to result in profits pretty quickly when the stock goes in your favor. He made $1,465 in that 2-week time frame. All right, so the stock went from what, 190 something, 194 to 210. He made $1,465 in that time frame. All right, and he had all this wiggle room to be wrong. All right, earlier I mentioned our base system that we've got, which tracks just the S&P. It historically ranges between 80% win rate all the way up to about 90% win rate. It was closer to the 90% win rate up until the last several months. This election kind of, and a lot of the volatility surrounding what's been going on, the market kind of going up and down. We're still 80 to 90% win rate. Typically, a winning trade in that system makes about a 7% gain. All right. When you have a losing trade in this system, it's going to be a little bit bigger than your typical win. So like a 14% loss. And you're like, oh man, how could I make money if I'm making 7% but losing 14? Now, hopefully you're seeing the answer to that. If you've got a lot more winners than losers, that's how you could do something like that. Well, let's just, for those of you who like math a little bit, if you had a 90% winning system, that would mean for every 10 trades, you'd have 9 winners and 1 loser. All right, so if you had 9 winners and made $700, you'd make $6,300. But you'd have a loser in there and you'd lose $1,400. A net profit for the end of the month of $4,900. Well, what if things weren't as good? What if you weren't 90%? What if you were 80%, which is on the lower end of the scale for us, for this system, the S&P system? 10 trades, 8 winners, $700 each, $5,600, 2 losers, $1,400 loss each. You lose $2,800, netting $2,800. If you had a system that was net positive like that, what would an income system like that do for you? So basically, I mean, we're thinking like stair steps, right? You add, you add, you add. Now, don't get me wrong. There's going to be some months that you have a negative month, but over the course of time, you're going to be net positive. All right. So I'm seeing in the chat box, Jerome says it'd make me very happy. I'd grow my account faster, says Donald. I see someone on the YouTube site says, hey, this will still cover the rent or the mortgage. Yeah, that $1,200 goes a long way, right? TJ says, I could use those proceeds to help do other trades, like he says specifically to buy puts for insurance. Yeah. So let's build this into a little checklist for you. All right, I promised you that we'd kind of cover a checklist that you could use for these types of trades. The first thing that you've definitely got to do when you're thinking about doing credit spreads is determine the market's direction. All right, so if you happen to use VectorVest, I use VectorVest. VectorVest has got market timing signals built into it that say whether the market's going up or down. All right, so no matter what you choose or what you use, you've got to start off with market direction. Have a signal that tells you whether the market's going up or down. Why? Because the two trades that we looked at today, the first word in those trades was either bull or bear. All right, so you've got to know which one you're going to be picking. For us, it's black or white. We look at our signals, we say, hey, we're in a uptrend. We are only doing bull puts. If the market's going down, we are only doing bear calls. All right, so that is the first part of your checklist. Once you know that, if you think about it, if you know you're only looking for bull puts, then this next part, you've cut down your workload because now you're going to select your stock. And you don't have to look at every possible stock out there. What you're then going to do is say, all right, I'm bullish right now. I'm only going to be looking for rising stocks with good fundamentals. Now here at VectorVest, we've got a lot of great prudent searches. If you just hang out in that prudent folder or the retirement folder, you're going to come up with a lot of great looking stocks that you'd probably want to buy. But for us, we use the same type of searches to find stocks to do bullish trades on. So part two is to select a stock. Now, bearish trades, here at VectorVest, we have some pre-built searches to find stocks that are pretty bad stocks that are in downtrends. All right, so once you determine the market's direction, then you narrow down your list of stocks. Now, once you have your stocks, you're going to make sure that they meet the right criteria for your option trade, and you're going to set it up. Now, some of the things we didn't have time to get into today were, like, we didn't take a deep dive in the setup of the trade. Like, we didn't talk about expiration. Some people were asking about that. We're not going to sell options that expire years from now. We're going to do basically 21 to 45 days. Very short. Not next week. We got to give it a little bit of time. So we didn't have time today to get into things like open interest, delta, or expiration, or probability, and all things like that. But we did talk about how you can select your strike by just looking at where do I think the stock is not likely to go. That would be a great starting point. And then you're going to look at, all right, well, am I getting paid enough to do this trade? All right. Once you then set up the trade, you say, all right, where's the stock not likely to go? That's where I'm going to sell. And then I'm just going to buy the insurance, typically around the next strike, away from that one. Then you plan out the trade because you want to plan things out before you enter it. We did talk about this first part here, where you're going to take profits at 50% of the credit that you get. You want to adjust the trade to minimize losses. We did not have time today to talk about that one, but we did talk about this one where you close it at the short strike. That's where if the stock's going up, remember I drew those two lines like this. If the stock comes down and hits that price right there, you exit the trade and it would be a losing trade. All right. And then from there, once you have it all planned out and you have your plan of attack ready, you would then go to your broker to place the trade with the broker. All right. And remember, both of these things are done as one trade. All right. You just like click with the broker. It puts it on one order ticket and whoop, you send it off to the broker. All right. So at this point, you've got those 5 things. You're going to kind of take a look at your system. Where do you need help? My guess is you probably would be in this area. Correct me if I'm wrong. Kind of in those areas. Maybe some of you, probably if you're newer to options, need some help with the placing of the trade. So kind of take a look at those 5 things and you kind of say, all right, well, Where do I need to spend a little bit more time going a little bit deeper and learning a little bit more? What did you just kind of learn about your income system? So in the chat box, I'll give you 30 seconds. What did you just learn about your income system? Kind of looking at that. Where are the areas that I could say, where are you good? Where do you need help? But that's a lot for you to type in 30 seconds. Let me grab a quick drink. Keith says exiting the trade. Diana, setting up the trade. I need help on that one. Determining the direction. Taking profits. Getting approved with my brokerage account. Keith, just give your broker a call. They can help you with that. Planning the trade, timing. All right. Well, let me give you some action steps. Here at VectorVest, we do it. If you're on a trial or you use VectorVest at all, we do have a bunch of training available. Now, at this point, it comes down to, all right, how much time do you want to spend? Because you can definitely do a lot of learning on your own, researching some of the additional videos we've got here at VectorVest. At the start, I promised I was going to tell you where to go to get more help from us, especially if you want to get faster results. Because time is, I almost said of the essence, but some of you it is, but time could be money for you. You might not want to spend years and years trying to figure this out on your own. You might say, well, I want to get results very quickly. If it's okay with you, I'd like to spend about 5 minutes. Let me tell you about what I feel would be the next best step for you. All right. And that would be, if you want to get results fast, we put together a course called the Options Paycheck. In 7 weeks, you would have complete confidence in knowing every part, every nook and cranny of the system that you need. Hands down, we feel it's the best course out there to help you install an income system. All right. That way you can start generating consistent income each month. All right. I feel really confident to say that because we get comments like this all the time. I mentioned we see comments on our Facebook group. We have a private Facebook group of all our students. We have clients that we work with on a weekly basis. Joe is one of them. Joe took this course, just like, you're thinking about taking this course. Joe took the course, and then he wrote this to us 10 months later. All right, so picture yourself, 10 months from now and where Joe is. He says, I'm writing to thank you for teaching the Options Paycheck course. I took your class last fall and wanted you to know my results. I keep a journal to document every trade. Now, he profited 239 trades, so he is fairly active. Right? He's not just doing 10 trades a month. It looks like on average he's doing 35 trades. So he's doing stock trades, S&P trades. He's doing a mixture. He had a 68% winning rate. All right, that's right in the ballpark of what I had mentioned to you, between 60 and 90. He said he profited over $100,000 during that time. All right. He says, what's more exciting than that is that since my knowledge and experience have grown in regards to taking really good risk to reward trades, I've profited over $50,000 just in the last 6 weeks. And his success rate has gone up to 78% on his last 100 trades. So he's getting better and better at his skill. All right. And he says, I want to thank you again for teaching this simple but very effective system. All right. So what I want to do, I want to walk you through. The easiest way to explain it is just to tell you what you get in this course, and that way you can make a decision. All right. So first, what we're going to do is we're going to cover all the building blocks that you need to know in order to build a successful options trade. Because a lot of people try to build a successful income portfolio, but they base it on a portfolio based on weak information or a weak foundation. Right? It's like trying to build a skyscraper with a foundation that's 6 inches deep in sand, right? If you do that, everything comes crashing down. So the outcome you're going to get after Module 1 is you're going to know exactly how calls and puts work so you can confidently use them in your trades. You'll know what to pay attention to, what to ignore, and so you don't waste a lot of time. Module number 2 is all about getting paid whether the market's rising or falling. because the market, doesn't just go up like some people say on TV. So you need to know what to do to generate income if the market goes up or down. So the outcome here is you're going to know how to combine calls and puts to create income trades that have a 70% or better success rate. All right, you're going to know which is the right trade to use when the market goes up and which to use when the market goes down. Okay, next up in Module 3, it's about getting paid when the market moves sideways. All right, this is important because if you don't know what to do, sideways markets can be very frustrating. Right now, I've heard from people that over the last few months, the sideways movement in the market has been frustrating for a lot of people. Because just when you think it's safe to jump in, the market turns around, and then vice versa, right? So the outcome on Module 3 is you're going to learn the most powerful neutral market trade that's available out there. All right. Module number 4 teaches you the trade selection roadmap. This is important because you don't want to be wasting hours of your life digging around looking for your trades. You're going to know how to quickly find the best stocks to trade that give you the highest probability. And then Module 5, this is where you start to set up the trade. Okay? You want to start to put all of the probabilities in your favor. You're going to want to know which strikes to pick, what expiration to pick, which options to pick in the first place. Now, you're going to know exactly how to correctly set it up. And then in Module 6, this is where you're going to learn the trade management game plan. All right, today we talked about a couple of the rules on how to manage a trade, but you got to prepare yourself for what could happen after you place a trade. You don't want to be like the deer in the headlights, right? You don't want to be sitting there staring and frozen when something goes against you. You want to know exactly what you're going to do to exit. You're going to want to have a strategy for adjusting the trade if you need to. And the outcome of Module 6 is you're going to have that game plan in place. You're going to know exactly how many contracts to place. You're going to know how big of a position to have. You're going to know how to manage the trade. All right? And then in Module 7, those of you who said you had some hesitations about the broker, Module 7 will cover that because we're going to get in there and we're going to show you exactly how to place the trades with a broker. We're going to use several brokers as examples so that way you can see what it looks like to actually get in there and place the trades. All right. In addition, we've put everything that you need into a checklist so that you never miss a step. Those of you, I just heard from a pilot this morning via email. He's like, yeah, this is a great system for me because I love checklists. Right? So if you like checklists, especially if you're starting out or you don't have a lot of experience, printing out a checklist and following along, it makes sure that you never miss a step. Now, before I tell you about all the bonuses that you get, I did want to let you know that it is a 100% money back guarantee. All right, so you can go through the entire course with us, all of the modules, all of the training, everything we've got. And if you're not satisfied that we taught you how to generate income with options, you can ask for all of your money back, every cent. All right? All that we ask is that you do the work. Come to the sessions or watch the recordings. Do the work because we know if you do the work, you're going to get the results. All right? When you do this system, the base system that we teach generates 3% per month on average, right? Let's say over the course of a year, you're going to look back and say, oh, my average monthly gain was 3% per month. All right? It's a nice steady income stream. You're not going to have 1 month where you're up 36% and then 11 months where you're zero. Right? You're going to be on average right around the 3%. There's going to be some months where you might have a flat or a losing month. Another month you'll be at 5, right? But on average, you're going to be targeting that 3% per month. All right? And it doesn't take a lot of time to do. But before I tell you about the price, I do want to let you know, and it's important that you understand this is not some get-rich-quick scheme. Right? It's not something where you should expect to become a millionaire tomorrow. Right? This is something serious. It requires effort on your part. If you're not going to commit to it, then don't do it. Log out now. In fact, we would rather you log out than join the session, not do anything, and then ask for your money back. All right, this is for serious people. We only want to work with people who are serious about this because we take it seriously. We want to help you. All right, so if you are serious and ready to do the work and get results, the Options Paycheck course is perfect for you. You're going to get the entire course delivered live and via recording. We have a private Facebook group of students who have already purchased this course, who purchased it yesterday or last week. They are in the Facebook group saying they've already started going through module 1 and 2, and they're like tremendous learning. It's like opening their eyes already. So if you buy today, you're going to get immediate access to all of the training before we even have a live session with you. So you could actually go through the entire course before we even have a live session with you. All right, so you're going to get it live and via recording. Plus, we put together separate training we call the SPX paycheck. All right, this is where we take the entire course and we boil it down into something that you can do in like 15 minutes a week, because it involves one ticker symbol, which is the SPX, one trade type, bull put, bear call, one setup rule, one profit rule, one stop criteria. It's simple and easy to do. All right. In fact, I was able to teach my daughter when she was 14 years old. I sat her down. She had a spiral bound notebook on. I actually have it here in my drawer because she gave it to me like for memorabilia. She gave it to me. She wrote down the rules and she was able to go into my brokerage account, follow what she wrote down in her book, and place the trades. So if she could do it, I'm pretty confident you can do it as well. All right. You get 7 live mastery sessions. So you get the 7 live training sessions each week. Plus, you're going to get an additional training session, or we call it a mastery session, later in the week, where we go through implementation, answer your questions, get in there, help you with the homework. As the course goes on, we're going to be getting in there and actually looking at live trading opportunities. I already mentioned the private Facebook group. We've got people in there right now. So if you join today, by tomorrow afternoon, you could be in there saying hello to your fellow students. All right, interacting with people. Plus, you're going to, after the course is over, it doesn't end. We're going to move you into our alumni group, which has got, I think, a couple thousand people in it now, of people who have gone through the same training as you. They're sharing ideas virtually every day. I was just reading that a post that just came in over the past couple of days where people were saying, hey, I'm implementing the SPX system. How is everybody doing? And people were sharing the ways that they've tweaked it and that they feel they've made it better. And they're just sharing ideas on the page there. But I think the biggest benefit of this is you get 12 months of live Q&As from us. All right, so we'll hop in there and do a live Q&A with you each month. You get 7 weeks of access to our members-only group coaching. This is an exclusive group of our coaching clients. All right, this is where Ron Wheeler, our options trading coach, he gets in there and you'll see him in real time finding, selecting, setting up, managing trades. And then some people take those trades. We're not a financial advisory service, but we show you the trades that we're going to take. And some people choose to get into the same trades. All right. You get access to that while you're going through the course. You get 7 weeks of access to the software that we use, right? If you currently do not have either VectorVest or Options Pro software, we'll give you access during the course. Earlier, I mentioned that there's a checklist. One of the checklist items, if you want to put it on there, is having a tool that helps you do all those things. You could use your broker. We like to use VectorVest and Options Pro to get the work done a little faster. We use VectorVest to scan the market, find the stocks. We use Options Pro to find the best return, the highest probability, things like that. All right. So during the period of the course, if you don't have access to them, we'll give you access to them. Those of you who were either have no experience or are beginners with options, we're going to give you a thing called the Options Foundation course. I read a post on Facebook just today where somebody said, I'm brand new to options, and I started going through the Options Foundation course. And he was very funny. He said, I'm going through the Options Foundation course, and after I'm done, I tell my wife what I learned to see if I'm able to explain it to her, and he's testing his knowledge that way. He's like, I think she's going to become a better option trader than I am. So go through the Options Foundation course. That's another bonus. It'll help you get up to speed on options before you even hop into the paycheck course. We got people in our Facebook group who took the course before. Shun says, I just took the tips taught in the Options Fundamentals course on buying a call, made his first 7 option trades in his entire life. All right. And he went on to say, it's already paid the class in full. Bobby says, I'm even more excited for the course today. I made real money with the S&P trade that he opened yesterday, and he closed it to pay half of the course fee already. So here's what you get. Let me wrap things up. You get all these bonuses, right? All right, total value over $6,800. Here's what we'd love to do. We're going to roll up our sleeves. We're going to work with you, even if you've never had success with options. We're going to do this together. All right. You get all these bonuses. You spent about an hour with me today. All right. If you go to optionspaycheck.com, the course is $9.95. All right. Early bird price, $9.95. However, like I said, you've spent an hour with me today. Here's what we'd love to do, just for you. If you order before the end of the webinar, instead of paying $9.95, you can get it for $8.95. All right, that's only available while we're live today. So we just put that link into the chat box for you. So you just click on the link in the chat, optionspaycheck.com. You'll be able to get it for $8.95 while we're here. It is even lower than our elite pricing. That means you'll get the full course, 1 year of access to the course, 7 live sessions, the bonuses, all that stuff, all the bonuses for $8.95. Plus, remember, 100% money back guarantee. I usually like to ask this. That's why we put it in the slides. How much is it costing you if you don't do it? How much money would you lose learning by trial and error? How much time and energy you're going to spend doing that? How much potential profit would you miss out on? Remember Joe? What if Joe did not do this and waited 10 months before he ordered? He basically would have missed out on $100,000. The other question I have, what if I asked Joe, would he trade $895 knowing that he would make $100,000 10 months later? He'd probably say, yeah, every day of the week. All right. Ask yourself, how would your life be different if you do this and it works? Now, it's not too late. Granted, 20 years ago would have been better to learn a system like this. We can't go back in time. I don't have the time machine. But what we can do is affect what you do right now. All right? If you do want to learn this system and get fast results, go to optionspaycheck.com. Join us. You get the discounted rate of $8.95. All right? Again, it's while we're live on this webinar, it's $8.95. It's even lower than our elite pricing. So optionspaycheck.com. In the chat box, if you know this is for you, in the chat box, just type in, I'm in. 2 words, I'm in. I'd love to welcome you and say hi. I'll probably see you in the Facebook group. I was just responding to a bunch of people in the Facebook group. By the way, if you go to optionspaycheck.com, the page will look something like this. I shouldn't say something like this. It'll look exactly like this. So you go to optionspaycheck.com. You'll see a button that says register now. Just click on it. And you can see $8.95. Now that will go away. That'll go up to $9.95 when the session is over today. And then on Monday, it'll go up to $1,495. And then registration closes on Wednesday next week. All right, so you only have a week to decide, but you have basically 15 minutes to get it at the low rate here. All right, and then when you get into the course, I think I got that over here. Oh, no, hold on. When you get into the course, this is what the course would look like. And remember, you have access to this immediately. All right, you can hop in there right now after you buy. You can go through the presentation. Right, you can listen to the Q&A of the people who attended the live session the last time we taught it. After you guys have your live session, we will overwrite this with yours. There's a homework assignment, the mastery session. You get to listen to the mastery session that we did with the last class, and then we'll overwrite that with yours once it's done. We had a bunch of supporting videos. Then you take a test to make sure to test your knowledge, all the way down through all the modules. You get all the bonus trading system right here. Then we'll give you the recordings of all the coaching sessions that I mentioned in the resources section. We got you get the slides, black and white versions of those. You get the checklists, position sizing worksheets, and so on. Get a trade tracking spreadsheet, all available to you immediately after you register. So let me go back, look over at the chat box. Woo! Remember, if you're in, say I'm in. So I see the first ones I'm trying to see here. Sam says I'm in. Ali says I'm in. Tom says I'm in. Jerome says I'm in. Yes, Girish. We have people in the UK who do this as well. Now you'd have to be, you do US stocks, right? You'd have to have a broker that allows you to trade US options. Paul is in. Diana is in. Welcome to all of you. You should have an email immediately in your inbox. So check your junk or spam folder if you don't see it in your inbox. All right. Ed says I'm in. That email will have a link to the course. It'll have directions to the course. It'll tell you the dates and the times of the live sessions. It'll give you a link to the Facebook group. Click on that and join the Facebook group. We'll get you in within about 24 hours. So it'll have all the details. I just recommend you print it out and keep it handy. All right. So I'm going to answer a bunch of questions that I see coming in. By the way, if you're listening on YouTube, hit the comment on how the session went, but hit the little thumbs up. Let me know that you learned something today. That you can let me know that by just hitting the little thumbs up. You don't have to put a comment if you don't want to. But I'm going to look at the chat. The biggest question I see some questions that have come in from Garish and Gary and Gilberto. But one of the questions that I see would be, the dates and the times of the live session. So let me just show that to you now. All right, so these are the live trainings. So what Ron Wheeler, who is our options trading coach, he'll teach module 1 on May 6th. Then module 2 and so on through module 7. All right, those are the live sessions. They start at 4:30. We find that that's the best time. We can get the most amount of people in those live sessions. All right, so later in the week, we get back together and do a mastery session. All right, so you see they're a little spread out on here. So this will be mastery session number 1 all the way through 7 over here. And remember, those are where Ron Wheeler will get together with you and check your knowledge, answer your questions, help you with the homework, walk you through examples. All right? He'll make sure that you understand what's going on. Now, these sessions are at noon Eastern time because we want the stock market to be open. Because as you get later and later through the modules, let's say by module 6, in that mastery session, he's going to walk you through the checklist and show you basically finding a trade that day. All right? All right, so let me go back over to the question log. Oh, so the next thing you might be thinking on that is, do I have to attend the live sessions? And the answer is no. Like, number 1, we'll record those mastery sessions and put them into the course for you. If you have a question and you can't make it to a session, you could either post it to Facebook and we'll answer it during the live session, or we'll just reply to you via email or on Facebook. So email us or post on Facebook. All right. So I'm going to go back up. There's a few people that had typed in a question. Gilberto says, what if I purchase now but can't start until later? Well, you have access to the course for a full year. Okay. So if it takes you, well, I don't know what later means for you, Gilberto, but if later just means a couple of weeks, you'll still have access to of course, the coursework. Now, the only thing that's going to have an end date would be the software. That you have access to during the next 7 weeks, starting on the first day of class. All right, so basically you'll have access to the software from May and June. I'm not rough dates, right? May and June. But you'll have access to the course materials, the videos and the PowerPoints and all that for a year. All right, so there's no rush. Now, Gary says, so you can take the course anytime or is it live? All right, so I'm going to answer that two ways. Number one would be the same answer I gave Gilberto. You have access to it for 12 months. So you can go through the material anytime you want. All right. The benefit of doing it now is there are live sessions as bonuses. Gary, if you order after registration closes, right? Let me just go back over to my little calendar. Registration closes on the 5th. Right? At midnight on the 5th, we will close registration. So if you decide to place your order, let's say on the 7th, if you place your order on the 7th, it will cost you $1,990. That's our regular rate for this course. Right? So it'll be full price, and there are no live sessions that you would get. So the benefit of doing it right now would be $895, and you get the software as a bonus. You get our live coaching as a bonus, like a whole bunch of live stuff as bonuses. All right. I got a note that Shiana on YouTube is in. It says, I got in. And it says, I think this will be great. I agree with you. I think this will be great. All right. Now's your chance to type in questions in the chat box. Thomas says, how long does each module take? Each module is about 60 to 90 minutes to go through. Then you might want to dedicate a little bit of time to go through the homework. You might want to dedicate some time to either attend the mastery session or just listen to the recording of it. That's about 60 minutes. One of the things I think you also should do is on the bonus that you get, these bonus coaching sessions, even if you can't attend those live, I'd recommend you watch at least one of them. Right? That way you can kind of see what Ron does with his coaching clients. And for example, this last one on March 22nd, that wasn't that long ago. It was about a month ago. In this session, you could see Ron is going through the checklist. He's checking the market's direction. Then he's looking for a trade. Right? He's showing you how he sets up his trades. And then you can see he's showing you, all right, now I'm going to my broker and I'm placing the trade. So he walks you through live trades in those bonuses. So you're invited to attend those live if you want, or you could just watch the recording of it. Hopefully that helped, Thomas. Leroy says, I'm in. Welcome, Leroy. Sal says, can we implement what we learned without the VectorVest software after the 7 weeks expire? You could. Yeah, we've had some people. Now, some people choose to use just VectorVest. They don't get the Options Pro software. Some people get both. Some people, pardon me, sorry, I got a tickle in my throat. Some people would say, hey, I like the SPX system. And the benefit of the SPX system is it's very straightforward. You could do that just really simply with just your broker, because it's just one ticker symbol. It's the SPX. One of the gentlemen that I'm thinking of, his name's Jim. He's on our website as one of our testimonials. His profits that you see there were all just S&P profits. That's actually one of the main trades that people do, especially when they're first starting out, is the S&P system. And Mike, the options, I see that question coming through. Mike, the Options Pro software becomes available. Where is it? Where's my date? By the first day of class, right here, by the 6th. Now we might get it done, a day earlier or a couple days earlier, but we say by the 6th. That actually looked like a tomato did you guys see that? And I haven't had a tea. Anyway, that's my answer. I'm sticking to it. I guess you got to have fun when you're doing the webinars too, right? Anyway, taking a look here. Mark says, all right, I'm ready to start. Beautiful. Yep, and the Options Pro software will be available from the 6th all the way through June 25th. Over to here. So 7 weeks. So like 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks, 7 weeks. You have access to the software. I'm just going nuts with my drawing now. All right, so I'm going to give you the last few seconds if there's any other questions. I don't see any. We are really excited. We love teaching this course. Gary says I'm in. Welcome, Gary. Check your email. Hop on to the Facebook group with us. So those of you who are in, hit the button, click on the link in the email to join the group. And then once you click on that link, there's a button on the page that says join group. Now, it's not mandatory that you join the Facebook group. I understand, I don't like a lot of what Facebook does myself. But, there's no other platform out there that everybody uses that we can interact so easily on. If there was, we would use it. So hop into the Facebook group. You can create a fake account if you want to. Now, you can, but as long as when you register for the group, you tell us who you are. That way we know who we're letting in, and it's only students. So Jerome says I'm in. Welcome, Jerome. Yeah, Girish, as far as the UK brokers, the last time we have a managing director over in the UK. His name's David Paul. You might have heard of him. But the last time I spoke to him, at the time he was saying that Tastyworks was one that he hears a lot from the people he works with over in the UK. That shocked me, but Interactive Brokers is typically another one that is they brand themselves pretty much as, hey, they cover everywhere. But you'd have to give your broker a call. Karan says, I've never used options before. I'm completely new to the system. Will this course still be helpful? Yes, because what we're going to do, Karan, is in the first module of the course, which I don't have the modules listed. Just with that first module, we will teach you options basics. We'll get you up to speed with a nice foundation. Other than that, Karan, remember one of the bonuses that you get is an entire course that we put together called the Option Foundation Builder. That's where we put together 5 or 6 modules where we will teach you what a call is, what it means to buy one, what it means to sell one, what a put is, what it means to buy one and sell one. Now, that foundation course does not teach you a complete system, but it teaches you what options are. And that, use the time between now and the first live session to go through that foundation course. That way, when you hop into the paycheck course, you would already have that nice, strong foundation on calls and puts. All right, Thomas says I'm in. Harry says, on a bear call spread, what's the ideal percentage difference between the sell and buy price? Right, you're talking about the call you sell and the call you buy. I would say there's an ideal difference between the two. Many times, like if it's a $5 spread, we're always going to check the next spread, like the next strike. We're going to check if it's a $5, we're going to go to the typically the next strike. If there's like $2.50 spread, we'll do the next one. If the stock has $1 spread, like $1 strike differences, we could check the next strike, which just $1 apart, or we'll just say, all right, well, let's check $2 or $3 away. So there's no ideal difference there. The key is we look at the risk to reward. Now, we teach this in module 6, where when we're setting up the trade, we're going to look at, all right, this is how much of the premium that we're getting. Let's take a look at how much we're going to lose on the trade if it goes against us. And we're going to make sure it's got the right risk to reward. And then we could move around the insurance strike a little bit if we want to. We say, oh, let's move the insurance strike a little bit farther away and see if we still get a good risk to reward. Karan says, what would be the investment amount to start with? 10,000. You say 10,000 or more. 10,000 actually is a really nice number. And you could do it with less than that. One of the gentlemen we interviewed, I was surprised. He had tremendous success, and he was using a $5,000 account. Right, so you can do it with less. All right, because if you think about it, you could, if you had, let's say, a $5,000 account, and remember that Costco trade I showed earlier, the maximum risk was $375. So you'd be able to place that trade in a $5,000 account. And if it went against you, you're not going to lose $375. We don't hold these trades till expiration and lose the max. The max loss is typically around what the gain would be. All right, so I think in that example when I showed it, the profit was like, let's just call it $150. That's the credit. So our profit target would be like 75. We try to set it up so that if the trade goes against us, we'd lose about 75, like a 1-to-1 type of scenario. So in that case, you could do, a couple of contracts or just do more than one trade. All right, guys and gals. I'm looking at the clock. I'm looking at the chat box. I'm going to say it's time to wrap up. So again, go to optionspaycheck.com. Go there now and then click the link up at the top. And the link up at the top will bring you to a page where you can see the discounted rate. And other than that, have a great rest of your night. Hopefully we'll see you in the class and on the Facebook group. And we'll see you in the Options Paycheck course. Good night.